Thanks, Jasmine. Hello, everybody. My name's Jack Hardman. I'm from Clifford. I'm a counsel in our regulatory and fintech practice here, and I lead both of those practices for the region. A bit of background on the firm. We are a leader both locally and internationally in fintech, and tier one ranked. And our main area of focus is to help local fintechs with both financial regulatory matters, corporate establishments, commercial contracts, and incorporating international best practices with our global tech team. I think we try and marry the two together and focus on development of the regulatory framework in the region. So you've got my details here. Do take a note, and then please feel free to contact me after this session with any follow-up queries. But also, as we're going through today, please don't hesitate to raise your hand and raise a question. And hopefully Yasmin will be able to track and shout if anyone wants to raise something as we go through. And I'm also happy to stay on at the end for your questions. The purpose of today's session is to give a very high-level overview of financial regulation in the region, to help you understand a little more about the regulatory framework here, the interplay between DIFC and the UAE and other jurisdictions, and some considerations about what you need to think about in terms of the impact of financial regulation, both on your business, but also your counterparty and if you're dealing with a bank, what sort of regulatory issues they're going to have that you're going to have to solve as well in your various propositions. So quite high level, nothing too specific, but do ask questions as we go through if you have any specifics. But I think the point of the session is to get an idea of that and then take away from the framework, think about how regulation may apply to you, and then take advantage of the fact that we can have a follow-up one-on-one session as might be helpful to help you further think about applying what we talked about in respect of your particular proposition. So just step back on the UAE regulatory landscape. The UAE is obviously made up of several free zones, and the DIFC is a financial free zone within that. And the financial free zone is separate from other types of free zones because in the UAE constitution, it is separate as a matter of commercial and contract laws. So all types of financial regulation in the DIFC are separate from the rest of the UAE, and almost a separate country as regards financial regulation and other types of commercial laws. Only the penal code and other criminal laws from the UAE apply in the DIFC, and that would include AML as an example. The other financial free zone is, of course, ADGM down in Abu Dhabi. Other free zones in the UAE are different to the financial free zones, ADGM and DIFC. They are more trade free zones. They will have separate commercial licensing laws and certain slightly different companies laws, but otherwise financial regulations will apply in those free zones as if they're in the rest of the UAE, so that they're not separated from a financial regulatory perspective. And the other kicker that comes with being the financial free zones is that there are certain restrictions preventing the financial free zones from taking business from the UAE market. So you cannot deal in the dirham and take deposits from the state market as a DIFC bank. Those restrictions do come up from time to time in terms of dirham-based products and services being provided out of the DIFC, and are generally not an issue for firms other than the banks. But if dirham business is part of your business, then we can talk further about that later. So the UAE regulators outside the DIFC, the Securities and Commodities Authority, which is perhaps less prominent from financial services perspective, but is a major player now in the regulation of securities business, investment management, financial advice, everything to do with the capital markets, which they supervise, and various related functions. And they recently issued a new rule book we'll talk about. So anything to do with securities business is the SCA. Central bank is everything else, including insurance now. So that's your ordinary banking activities, lending, FX derivatives, certain structured products, and other types of products and services that banks typically enter into as part of their business, and of course payment services stored value and related types of payments business is also regulated now by the central bank, and obviously insurance has been folded into the central bank recently after a merger with the insurance authority. There are certain data protection bodies within the UAE. There's no set data protection law outside of data protection requirements of the regulators, but there are specific regimes to consider for firms seeking to use data in the UAE and outsource. And then the final type of regulator applicable for financial services is UAE and AML and counter-terrorist financing and sanctions regulation, which is handled by the UAE authorities, as well as delegated to the central bank financial intelligence units. So that the regulation of AML is a bit broader than just the banks, because it captures things like brokers of precious metals and consulting firms and lawyers. So it's a bit of a broader framework regulated by the UAE authorities, but in respect of the oversight of and reporting for financial crime, that's delegated to the central bank. So having looked at the UAE framework, the financial free zones are comprised of the DIFC authority and the Dfsa, and as you'll be aware, the DIFC authority is where you get your commercial license for and corporate filings and data protection filings, whereas the Dfsa is a very separate regulator capturing financial services regulation and is a lot more has a much more extensive oversight function in respect of the business of financial services firms, but does not regulate firms that don't conduct financial services. So in terms of that financial services framework and the DIFC, we're going to have a quick run through of the DIFC financial services framework and the rule book of the DFSA. So the way this is set up and within the DIFC, the way that you're regulated as a financial service provider is whether you are conducting a regulated activity by way of business in the DIFC. So you need a license from the DFSA if you're conducting one of these long list of regulated activities, and you're not just doing it temporarily, you're doing it as a form of business. So you're not doing it for your own account, you're not doing it for a group member, you're not doing it as an ancillary type of business compared to something else. You're doing it, you're holding yourself out as doing that business, and you're doing it in or from the DIFC. So the list of activities is quite extensive and growing. It includes things like acting as a marketing agent, a rep office for an overseas business. It involves merely arranging financial services transactions. So you might not be issuing a product or even advising on it, but you might help someone sign an application form or something like that. That is arranging business. And increasingly, the DFSA's scope is increasing into payment services, and we've seen a recent consultation on security tokens that's going to be issued recently. So security token business will be specifically regulated in the coming few months. I think it's worth noting on payment services, this point about arranging businesses is important, because the DFSA rulebook is a lot more extensive than others in respect of its regulation of payment services. So payment services, arranging for someone else to receive payment services is also regulated as opposed to just providing payment services. So if you're helping someone to get payment services, you're providing part of maybe a credit card acquiring function, that could be considered to be conducting payment services in the DIFC, whereas on the PSD rulebook in the EU, or even in the ADGM rulebook, you might not be within their regulatory perimeter, but the DFSA has quite a broad perimeter in respect to payment services. So just be careful before ruling out that you need to be regulated in the payment space. As I said, there are a number of exemptions. So if you're just providing if you're just providing financial services intragroup, so to group members, then that's not captured. So the other pillar, if you're not providing regulated activities in the DFC as your business, the other area where you might be captured is if you're providing financial promotions to people. So you might not be actually providing those services here, but if you are part of a marketing function. So if someone not in the DIFC is sending promotions in respect of financial products or financial services to people in the DIFC, and that can be anything really, a marketing brochure to suggest that someone buys a certain investment product, information about financial services that are available, and promoting a financial service provider. These sort of marketing material, if it's sent to a person in the DIFC, then it could be considered to be a financial promotion and is restricted to firms authorized by the DFSA to do that, or you have to fall within one of several exemptions from the financial promotions regime. So one of the typical ones is that if someone in the DIFC requests information about a product and service to somebody, then providing that marketing in response to such request is exempt from the financial promotion regime. So you can do that. You can follow up with a request from somebody with the brochure. Another one is that you're able to provide financial services promotions to people who are designated as professional clients, and that's a sort of institutional client type category that requires you to assess the standing of that person and designate them as professional. And we can talk further about what the definition of professional client is later. So having worked out whether you fall within the regulatory perimeter in some way, either you're providing financial services or you're promoting them, you need to think about what licensing category you'll fall under, and the typical categories that you might have seen in terms of category 1, category 2, category 3, category 4, etc., that people talk about. You're a Cat 4. This derives from the Prudential Rulebook, so the rulebook for capital requirements and the amount of cash you need to have in order to be licensed by the DFSA. And the way the DFSA breaks it down is to categorize firms by their prudential significance. So if you are a bank, you are very prudentially significant, and that means that people are relying upon you to be able to repay them money. And if you fall under, then you are exposing the financial system. So that's very significant from the DFSA's perspective. So the banks are Cat 1, then Cat 2 is people like lenders of money and others providing dealing in respect of securities as a principle. So people are relying upon you to sort of give them money and deal in their securities. So again, that's quite significant. So that's category 2. Category 3 is then things like managing assets, providing some more limited brokerage functions, and certain types of fund management activities, and acting as a custodian. So in this sense, you're less potentially significant as you're really sort of safeguarding assets. Cat 4 is then the lowest category, and that's really more like advising and arranging business. So you're not actually holding money. Generally, you might hold some client money, but you're typically not. You're typically just advising and arranging transactions which are booked in another jurisdiction. So that's generally where the categories come down to. And I think you need to find which category you fit in there, and that will give you, both your prudential requirements, but also the sort of the extent to which the DFSA, will regulate you. The amount of financial services regulation depends, on your prudential category. So the amount of systems and controls, full-time employees, and other matters that a Cat 4 needs to have is very different to what a Cat 1 bank would be expected to have for obvious reasons. The second key area, once you've worked out, where you sit in the prudential framework, is the fact who your client's going to be and how you're going to onboard them. So as you're probably aware, the DFSA, the DIFC is typically a wholesale center. So the regime is really designed for wholesale clients, and you need specific approvals to be able to provide products and services to retail clients. And those are people who are not, professionals. They're not institutions. They're not regulated, and they're not high net worth individuals. It's people sort of falling out of that category. It tends to be retail. And if you're doing that, you need a specific endorsement from the DFSA. Once you sort of work out what type of clients you'll have to classify them accordingly, and then conduct an AML assessment to onboard them, which will not be new to people familiar with compliance frameworks. But that the AML onboarding is essentially applying Uae AML laws, which, as we discussed, apply in the DIFC, but with a bit of a bolt-on for the DFSA's expectations in terms of adopting an appropriately risk-adjusted AML oversight framework, which is in compliance with sort of FATF standards, and a sort of annual business risk assessment in respect of your AML exposures. So I think financial crime exposure considerations is a key sort of initial point to think about when setting up. Authorized individuals. So having thought about the financial service regime and then where you fit into it and your sort of capital and AML, then the persons who are going to run your operation will eventually be classified as authorized individuals. That's the senior managers of your arrangement will be approved or authorized by the DFSA to act as senior individuals for your operation. The senior executive officer is the most significant in that regard. There's a compliance manager, finance director, and then others really doing a senior manager role. And those persons are also have to comply with a number of principles such as integrity, open honesty with the regulator, and other types of principles which allow the DFSA to take individual action against specific authorized individuals if they fall short of those standards. So that's an important thing to remember, that the DFSA regulations don't just apply to the firm, they also apply to those specific senior individuals who will need to be cognizant of their duties both to their company and to the DFSA. Systems and controls. So you may have seen the DFSA's GEN rulebook, and the GEN rulebook is a general set of requirements for all firms to follow, and it sets out what types of systems and controls you need, what type of staff you need, the sufficiency of your IT systems, the risk management function you have, and other types of things such as record keeping and other administrative requirements that you only need to satisfy as a firm here. And as I said, the amount of systems and controls that you'll have to follow will deviate depending on whether you're Cat 1 or Cat 4. So that, I think that's the general, but there to go through in each case. And finally, once you've worked out the where you fit in the perimeter, your capital, your system and controls requirements, and who your staff are going to be, there will be annual and other periodic reports for the DFSA to be aware of. So, your team will have to prepare annual reports in respect of your AML exposures, annual reports in respect to your financial arrangements, keep up to date a regulatory business plan in terms of the scope of your operations, etc. So there's that reporting aspect that you'll need as well. So I think that's the broad regulatory framework to bear in mind there, and we'll sort of get these slides around later. But that's sort of where we see the important things to think about from a DFSA's perspective. The particular hot topics that the DFSA has been more concerned about over time. The first one, suitability. So if anyone's providing advice to clients in respect of their consummation of financial products or financial services, then those recommendations should be suitable for the investor. And there are various times when you can avoid conducting suitability assessments, but this is a hot topic because over past years, firms have buried something in terms and conditions to say we are not considering suitability requirements for you in this case, and they've considered that should exempt them of the responsibility to do that. The DFSA has acted out against that and found that's inappropriate. So if you're providing these recommendations, you need to think carefully about how you're making them suitable for your client base, and if you are not planning to conduct a suitability assessment, then you need to think about specific arrangements in place to avoid needing to do that, which generally would require certain client consent. But there are exemptions to suitability as well. So if it's a big point for you, let us know, because it's a key area. AML, obviously, talked about. Financial crime compliance is, the absolute number one concern of the DFSA. So you have to make sure you have a thorough compliance assessment. So if the DFSA says, right, we're coming next week to do an assessment of your KYC and onboarding requirements, they'll want to see evidence of the fact you can quickly put your finger on the onboarding KYC documentation that you've got for each of your customers, how you classified them, and how you've conducted the financial crime risks associated with that business, and present to them on that point. And that could be a quite short notice. So I think you need to be very careful in terms of how you set that up, so you have both a comprehensive framework, but also if you're using an outsourced provider for compliance, that you have good access to the systems and records, and you know exactly what the outsourced provider is doing. So if you do end up in that situation of speaking to the DFSA, then you're in good place to do so. And it's also critical to avoid any sorts of issues arising, because it's the sort of end of your business if you end up in a financial crime matter. Individual accountability is something I've talked about. Obviously, a huge theme in the UK and Europe about putting individual accountability on senior managers. So it's important that people who are senior managers and directors in your business are aware of the fact they have to be fully on top of what's going on at the firm, and available to speak to the DFSA if they have any queries, understand what the risks are, understand how these are being mitigated, and understand the the broad product offering and the way that the firm is compliant with the DFSA regulations in that regard, so we can answer questions. So I think it's important that senior staff and directors are made aware of their potential individual accountability from the DFSA. The last hot topic, client money. It's critical to be aware of when you're holding money on behalf of clients. So if clients send money to your firm to hold for them for any period, then it may be client money. And if it is, then you will have to follow various requirements to segregate that money properly, hold it with a proper bank, and have proper terms in place with your customers to both make them aware of how you're holding that client money and also make disclosures to them on a regular basis as to how that client money is being held. So there are it's not too onerous, but it is something that you have to have specific processes for if you may be holding money on behalf of clients, and if in doubt, adopt those principles of client money, so you're safe. So that is wrapping up on the DIFC regulatory framework. I don't know if there are any questions on that specifically, or we can move on. Okay. Yasmin, I might not be able to see if there are questions with my browser, so do let me know if you have any. Okay. So we have talked about the DIFC regulatory perimeter and how firms in the DIFC are regulated, the different types of regulated activities, the types of things that regulated businesses need to do and report to DFSA. But all that is really about what's happening in the DIFC. And as we discussed, the DIFC is constitutionally separate from the rest of the UAE from a financial regulatory perspective. So as a starting point, anyone in the DIFC cannot go and do business anywhere else or promote products and services to anywhere else without complying with the regulations in that other jurisdiction, irrespective of what you're regulated as in the DIFC, right? So if you're in the DIFC and you have a UAE client and you want to send them marketing materials about what you're doing, if those are regulated in the UAE, the services you plan to promote, by the central bank or the SCA we talked about, then you'll have to make sure that you're not going to fall foul of the financial promotions restrictions that the SCA and the central bank have in place. Now, there's obviously law and practice in this case, and the financial promotion rules can be quite strict, but of course there's a huge amount of tolerated practice that happens, right? So many firms carry on business with absolutely no issues cross-border. Other firms have been criticized for certain things, so you just have to be careful in how you approach cross-border, and where you can ensure that you're adopting a risk-based approach, takes into account how you approach clients, and that you've mitigated the risks of being considered to be conducting sort of unlawful financial promotions into UAE. And it's also obviously an issue not just in the UAE, but if you're going to Saudi or anywhere else in the world, frankly, where they have their own promotions regime. We'll talk a little bit about other jurisdictions in a second, but just in terms of the UAE, there are two rule books for financial promotions. We talked about the SCA and the central bank, and the SCA has the most sort of comprehensive financial promotions regime, and its recent rule book is actually, and I can send around our briefing for more information on this, but it's actually expanded the scope as to which you can make financial promotions to people in the UAE, which I think is quite helpful from a cross-border perspective. So you can make financial promotions to persons in the UAE if they request information about your business. So that's a reverse solicitation. That's fine as long as you document their request. You can send the promotions to them. You can also send promotions to professional investors, both companies and individuals, as long as they satisfy certain criteria, which is set out here on this slide, and we'll get these slides around afterwards. So these are large institutions, regulated institutions, government affiliated institutions. So sort of three sort of categories for the companies, basically. And then for individuals, it's persons with 4 million dirhams, excluding their home residence, or employees of regulated firms, or firms who are who are or used to be in the past 2 years. You can also make an assessment of whether the UAE person is sufficiently sophisticated to receive the promotion, but that's a bit more of a difficult hurdle to meet. So it's best to stick to, very objective criteria in terms of net worth and are they employed by a regulated entity. So there's a number of categories you fit in there, and it's quite a broad category really. So most of the time you will be able to categorize most sophisticated clients as professional. In terms of there's financial promotions aside, you need a license if you want to promote to clients, without falling within those exemptions. But at the same time, a separate regulation activity is making introductions in the UAE. So if you're in the UAE and you're introducing a UAE person to another financial service provider, then that is regulated as introduction business, and there's less scope for exemptions here. So it's a bit more there's a bit more uncertainty as to conducting introductions business. So if your business or uses or may involve introducers in the UAE who find business for you, you just need to focus on whether that's something that they're regulated to provide, and if they've got the requisite approvals from the SCA to make those financial introductions. So having considered the SCA regime, if it's not SCA regulated activities you're doing, if it's payment services, if it's banking, if it's credit, then the central bank's regime is probably more important than the SCA. Now, unfortunately, the central bank's regulations are generally not as helpful as the SCA ones in terms of cross-border business. So they don't really have exemptions for DIFC firms marketing to UAE persons. So they are quite difficult to navigate. We typically say that it would be tolerated to follow the same processes we just described for the SCA for central bank regulated activities, and our advice typically says that we expect the central bank would permit such activities. However, their express rules don't provide for that. So there is a heightened degree of risk with promoting to clients in respect of central bank regulated products and services. So I think you need to be quite careful in approaching that and having taking a more restrictive approach, making sure that you keep meetings, one-to-one and very specific. Try and get people to come meet you in the DIFC, keep things offshore where you can. And we can talk more about that if it's a specific issue for your business. One particular thing I would say is payment services. Payment services is in the process of flux in terms of its UAE regulation. So obviously we've recently seen the central bank come out with regulations covering store value facilities and a whole range of different types of payment services activities, including a specific restriction on financial free zone entities marketing payment services to persons in the UAE. Some quite sort of detailed criteria in the store value regulations about when they consider that a firm is marketing into the UAE, even if it's managing a website to attract traffic from UAE persons. So they've been quite restrictive there, and I think they're really trying to promote people getting licenses onshore from the central bank to conduct payment services where you're targeting UAE customers for that. But on the other hand, it remains quite difficult to get such a license, and the central bank's policy is still evolving. So it is a tricky area of payment services. It is worth having a discussion with us if you're embarking on a payment services business that might be attracting sort of UAE business. We've advised a number of clients in navigating the framework presently, and I think so that's something to just to consider carefully. The central bank's regime for outsourcing is also more restricted than the SCA. So if you're dealing with a bank or a sort of central bank licensed entity and you're providing outsourced services to them, so you're helping them with KYC, or you're helping them with other types of regulatory functions, or other types of administration where the bank would be depending on you in order to deliver products and services to its clients. That sort of outsourcing is heavily regulated by the central bank, and there are a number of detailed restrictions, including that your outsourced service provider stores all the data in respect to customers onshore. So that can have some slight issues if you're doing that out of the DIFC. Just to be carefully aware of and think about with your your banking partners. How are you going to satisfy the outsourcing criteria of the central bank in providing those products and services. So having looked at the outsourcing regs, and it's quite a good segue into the guidelines recently issued for financial institutions adopting enabling technologies. And this is about the general principles that all of the Uae regulators have signed off on as being relevant to be considered when a bank or another financial service provider is adopting technologies and using an outsourced service provider, a tech company, to provide these services. And that goes from things like, AI functions to using a cloud or DLT, or really just adopting various APIs to sort of permit an open banking framework. And you'll see on this slide, we've listed a number of the requirements that need to be considered. So these are things like governance, ensuring that that there's a good framework in place to the bank has to govern how the outsourced service provider is operating, monitoring the approval, the performance of the outsourced service provider, and its compliance framework, business continuity, ensuring that there's a backup if there's a failure, making sure that there's plans to audit the provider, etc. So, and obviously the outsourcing points you mentioned. So I think that it's important that if you're providing these services to a bank or other financial service provider, then these principles will be relevant in how you might design your proposition to be compliant with what the bank will need to follow. It's interesting. They also go into sort of thinking about ethics in respect of AI, which is an interesting development, and also consumer protection standards, which are becoming increasingly relevant for the central bank, who has recently issued a very significant set of consumer protection regulations, which apply to any products and services that a Uae bank offers, and they're quite significant and causing quite a lot of time being implemented with the with central bank regulatory entities. Okay. So the last thing I just want to talk about today, and just a vested interest in this, because we drafted these regulations for the SCA, and this is the perhaps less publicized crypto assets regime onshore, which is the SCA's rulebook for dealing in crypto assets, which is currently being revised to be virtual assets in line with FATF. So we put these rules together a couple of years ago, and they've gradually made their way through the regulatory framework and have been issued. And the regulatory framework for crypto assets in the UAE, which includes promotion of crypto assets, is that if the crypto asset is a security, or if it's a regulated commodities token, it will be regulated like other types of securities that the SCA regulates. A regulated commodities token is a type of crypto asset which is available on an exchange, so is traded, unless it falls within various narrow exemptions. The idea is that the SCA wishes to regulate most types of crypto assets which are available for trading on exchanges and treated therefore as types of investment. So you would not capture things which are within private networks and not subject to sort of outward trading functions. But it does have a quite extensive potential remit there that the SCA might wish to regulate. The scope of regulation of crypto assets is currently in flux a bit, because the central bank is also regulating payment tokens, which are stable coins and other types of crypto assets. So there's a bit of flux in between the two regulators about how to regulate these, and also the new AML rules that have just come out focusing on virtual asset service providers in line with FATF is also causing will prompt a number of changes to the regulations to comply with international principles for the regulation of anti-financial crime measures in respect to crypto assets. So that's something to bear in mind. But basically, crypto is going to be increasingly regulated by the SCA, and they will treat crypto providers as financial service providers generally. So if you're doing brokerage, advice, custody business, arranging overseas transactions in the major cryptocurrencies, you're likely to need a license from the SCA soon. And there are a number of initiatives for firms trying to set up in this industry. There's sort of an MOU in place with the FCA and the DMCC and other zones to sort of facilitate set up in this area, but it's definitely a growing industry, and we expect the rules to be implemented soon to allow providers to get licensed. So that's crypto assets. Of course, we have separate regimes in the ADGM and DIFC looking at these. The DIFC one is in consultation, but ADGM is, has been live now for a number of years, and there's been quite a few, exchanges, crypto exchanges licensed so far. And so I think the ADGM has a very comprehensive crypto assets regime that has been implemented. But of course, the DFSA is also providing similar rules, and is consulting on a security tokens framework at the moment, which will provide for a holistic oversight of crypto assets regulated as which are securities in the DIFC, and have a number of sort of bolt-on requirements to be followed when issuing security tokens in and from the DIFC, with a new set of disclosures that are needed and various other types of measures to be adopted in respect of secondary trading, to try and enhance and support that framework in the DIFC, which we think will be quite positive for the industry. And we hear the DIFC is also going to be promoting other types of crypto asset regulations in the near future. So that's a whistle-stop tour of UAE financial regulation. The only other point I was just going to mention is thinking about other GCC jurisdictions and some sort of broad rules of thumb. So if you're promoting outside the UAE across the GCC, then similar requirements apply that we mentioned about ensuring that you're not conducting regulated financial services in those jurisdictions or conducting promotions. Saudi is the most restrictive and has recently changed its rules to become more restrictive in terms of the ability to promote products and services to Saudi persons. In most cases, you have to be a CMA authorized person or going through a CMA authorized person in Saudi to promote products and services, unless you're going to a regulated institution or SAMA, the Saudi Central Bank, or others like that. So it's quite difficult now to promote products and services in Saudi without a local license. In other jurisdictions in the GCC, it's a bit less clear. So Bahrain, Oman, Qatar generally permit cross-border where it's on a one-to-one basis on following a reverse solicitation. Kuwait is a little bit more restrictive, and you have to be more careful in Kuwait generally. But we tend to see that doing business cross-border into GCC is generally fine. For most firms being cautious about it, other than Saudi, where we see a specific issue and push from the Saudi Central Bank for firms to be setting up in the kingdom in order to promote services to people in Saudi Arabia. And that's it. So yeah, any questions, then extend the line. As I said, you got my. I'll just bring up my email again. Got my email here and my number. Do get in touch if you have any queries. Feel free to add me on LinkedIn. Send any queries over. We have time sort of dedicated to have some one-to-one sessions with the participants here. So don't hesitate to reach out to arrange a quick call about anything that you might be concerned about. And yeah, good luck with the process.
Oh, hello there. This is Ken from New Credit. I actually have a question regarding the DFSA kind of like monitoring the regulated firms, because we're also regulated in the EU, and we have enormous amounts of pressure from the EU regulators that we need to be employing persons, compliance person, risk person within the company. We cannot outsource just because the pandemic is actually having a big impact on the local job market, and they want everyone to be in-house. Is that the case in Dubai?
It depends on the type of firms. If you're a Cat 1 bank we talked about, then you probably wouldn't be able to outsource. But outsourcing is generally fine for category 4, so advising and arranging businesses. So it depends on your setup really, but usually it is permitted to outsource compliance and MLRO functions as long as those persons are resident in the UAE. So there are a number of providers who provide that function. The DFSA obviously prefers if it's in-house. So the typical measure we see is that firms use an outsourced compliance provider as a bridge until a local compliance officer is appointed once you have the necessary resources to be able to employ one. So that's typically what we see. The finance director can also be outsourced for the category 4 firms, and that can be someone anywhere. Doesn't need to be based in the UAE as long as they have the time and expertise to oversee the business. That's then generally okay for Cat 4, and then as you move up to sort of category 3, category 2, it becomes less and less permitted, and then category 2 firms and above, and I think category 3A as well, which is dealing as agent. They're required to have a specific risk officer appointed as well, so there's an additional staffing requirement for that category. And then obviously you always have an SEO who's full-time in the DIFC. Does that answer the question?
Yes. Thank you so much. Yeah.
Okay.
Thank you.
So I think we had a couple of chat questions. So sorry I missed those, and I couldn't see those as I was going through. So the first one's from Salman and ontology of rule books along with any coded practices. Well, there is a rule book. The DFSA has a rule book which you can go through. So the gen rule book is perhaps a good place to start because it sets out all the regulated activities and explains what they are with some guidance. So I'd start with the gen rule book and then sort of work your way through there.
Sure. Jack itself, from the question itself, just with a bit more clarity, number one, thank you for the great presentation. Just want to understand if the ontology created at the DFSA is actually sort of built based on a European regulation, or is it sort of coming from local regulation within the UAE and then gets translated into it? Is there maybe a rule of thumb we can follow where maybe perhaps if we are EU or Oz equivalent?
Yes. So that's a good point actually. Yes. So DFSA was created in 2004, and Clifford Chance helped to set it up. And the rule book was based upon the then FSA rule book. So before the FCA became the FSA became the FCA and PRA. So the then FSA rule book was sort of almost adopted, almost wholesale, and the DFSA rule book has been generally updated for European regulatory jurisprudence over time, but on the basis that it is taken from the original FSA handbook. But obviously there are things in the DFSA rule book which are slightly different. So provision of credit is regulated in the DIFC, which is not in Europe, and apart from consumer credit, and arranging business is a lot more. Arranging is a real business model of the DIFC because we have 800 firms, most of which are arranging business books offshore. So there's a huge arranging business is much more prevalent here because of its wholesale financial center nature. So obviously the rule book has been adapted over time to reflect the sort of business model of the firms in it. So it does deviate from European regulation in that regard, but is generally sort of keeping up with it, and certainly keeps up with IOSCO standards elsewhere. So the jurisprudence is coming out of Europe, I would say, rather than the UAE. And the DFC law has a sort of flow chart of implementation. So how that's designed is that you'll have DIFC sort of set laws, and then if you have a bit of a gap in terms of it's not really clear what the guidance is, then English common law will then prevail in the court, or it's supposed to anyway. So when we request the DFSA in terms of what our views are on certain things on their rules, if there's a bit of uncertainty, we will look to the UK as guidance. So we'll look to the PERG guidance manual that the FCA has published in order to help guide your thinking around how the DFSA rules should be interpreted. But of course, it's not best to go straight to that. I mean, if you're not sure about a rule, have a look at the consultation paper from the DFSA that was published in respect of that issuance. So money services, for example, a lot of uncertainty about how that regime is supposed to apply. Have a look at the consultation paper that was issued with the money services regime. Will give you a bit of background as to what the DFSA is intending with its scope of coverage. Hope that answers.
Great, thank you so much for that.
Question, yeah.
Yeah, it definitely does. That's great.
Yeah, if you've got any specific queries, do drop me a note. I'll put my email in the chat so you've got that. And the next question is about KSA. So I'm not going to be able to cover that in much detail on this call. There's obviously a payment services regime that's been implemented by the Saudi Central Bank recently, and that's quite extensive and talks about its requirements in respect of payment services firms. If that's relevant, I think there's some things in there about eKYC. But if you have any specific queries on that, please do drop me an email and I can put you in touch with our KSA team to have a quick chat about it. I wouldn't like to speak for them, given this is a rapidly developing area. Cool. Okay. Look, I'll wait for you to get in touch for follow-up ones. Don't hesitate, as I've said. And yeah, hope the session was helpful. Thanks a lot.